Welcome to Talk Tickers. Today, we're digging into a classic Wall Street head-scratcher with Allegro MicroSystems. Here's the situation. The company reports strong earnings, beats what the analysts were expecting, and the stock just tanks. So what's going on? Let's break down the numbers and figure out what the market is seeing that maybe the headlines missed. This is the million-dollar question, right? On the surface, everything looked pretty good, but the market's reaction, well, it tells a completely different story. To really get to the bottom of this, we first need to look at all the good news, the stuff that everyone saw right away. So let's kick things off with those big headline numbers from their Q1 report. The results that, on paper, really should have sent the stock flying higher. First up, revenue. They brought in $203.4 million. Now that is a solid beat and, get this, a 22% jump from this time last year. Pretty strong. Then you've got the earnings. The non-GAAP EPS landed right at 9 cents. That was pretty much exactly what everyone was expecting. So based on these two numbers alone, you're thinking, okay, everything looks great. So let's be super clear here. On the two big metrics that Wall Street watches like a hawk, revenue and earnings, Allegro absolutely delivered. They checked all the right boxes for what should have been a really, really good day. But the market's verdict was this, an almost 9% drop. Ouch. So it's clear the beat was just completely ignored. And this is where it gets interesting. We have to ask, why? To understand that disconnect, we have to look at the story management was telling on their earnings call. Because, let me tell you, they were not worried at all. They painted a picture of a business with some serious momentum. So here's how their revenue breaks down. And no surprise here, Automotive is the big engine driving this thing. But I want you to pay close attention to that industrial and other slice. It's smaller, sure, but its growth is a huge part of management's very bullish story. And this is the slide they really wanted you to see. This is the core of their whole argument. Management was hammering these year-over-year growth rates on the call. E-mobility, which is their key strategic focus, was up 31%. And that industrial segment we just talked about, up a staggering 50%. I mean, you really can't argue with those kinds of numbers. And the CEO, Mike Doogue, he came out and backed this all up. He pointed to really strong signs for the future. Things like new orders, what they call bookings, are up, and their backlog of future work is getting bigger. The message coming from the top was pure, unadulterated confidence. And their final point was all about financial discipline. See, they aren't just growing for growth's sake. They're actually generating a ton of cash, over $50 million, and they're using it to pay down their debt. This was basically management telling investors, hey, don't worry, our house is in order. Okay, so let's recap. We have this really clear story from management. You've got strong growth in all the right areas, a healthy pipeline of future business, and they're cleaning up their financials. Which, of course, brings us right back to our main question. If the inside story is so positive, why on earth did the market freak out? Well, here's the answer. It's really a tale of two completely different stories. It's all about what you focus on. On the left, you see what management was talking about: bookings, growth, cash flow. But on the right, that's what the market was focusing on: an actual accounting loss, weakness in the broader auto sector, and concerns about the stock's price. And right here is probably the biggest red flag for the market. While the adjusted earnings number was positive, the official accounting number, what's known as the GAAP result, was actually a loss. You can think of it like this. Non-GAAP is how the business is kind of running day to day, but GAAP is the final official score with all the rules applied. And for a lot of investors, a GAAP loss means the company isn't truly fundamentally profitable, at least not yet. Now, management also talked up their strong book-to-bill ratio. All that means is that new orders are coming in faster than they can ship product out, which is a fantastic sign for future demand. The problem is that optimism kind of exists in a vacuum. Other big players in the auto semiconductor space were sending out much more cautious signals. That got investors worried, wondering if maybe Allegro was just a lone bright spot in a sector that's actually starting to weaken. So that pretty much explains the disconnect from this past quarter. Now for the fun part. Let's look ahead. This is our take on what you should expect heading into their next earnings call. Okay, first, let's look at the company's own official forecast for the second quarter. They're telling us to expect continued growth. They see revenue up about 12% year over year at the midpoint, and that non-GAAP EPS number is projected to grow by an impressive 15%. So the outlook itself is actually quite strong. So with that guidance in mind, here's how we're going to frame our call. We'll start with the thesis, move to the prediction, and then wrap up with our final rating. All right, so here's our core thesis. Bottom line, Allegro's doing its job, and it's doing it well. The company's executing, especially in those really hot areas like e-mobility and industrial. The problem is they're fighting against a really strong tide of economic uncertainty in the auto sector, plus a dose of investor skepticism about whether the stock is already priced for perfection. And that leads us directly to our prediction. We fully expect Allegro is going to report results near the high end of its own strong guidance. They'll probably hit their numbers, but we just don't think it's going to be enough to kick off a major rally. The stock is likely going to stay stuck in a range, just trading sideways until the broader market gets undeniable proof that the auto industry has truly, finally turned a corner. And for all those reasons, our rating on the stock is market perform. Now, this is basically a neutral stance. It means we think the company's solid performance is pretty much balanced out by those big external risks. In our view, the stock is fairly valued right about here, at least until that bigger economic picture gets a whole lot clearer. And as always, just a reminder, this analysis is for informational purposes only. It is definitely not financial advice. Please be sure to do your own research before making any investment decisions.